Hi everyone, my name is Phil Clerkin from Libertas Wealth Management. Thanks very much for joining us today.
Hi, I'm Julie Preston. I'm one of the advisors here at Libertas, and today we're going to talk some more about risk. There are risks everywhere, and we want to give you some examples. So all investments come with some risk, and they also come with some volatility at some point. Understanding the difference between the two when investing is really important. Risk relates to the likelihood of the value of your investment going down. Investments that typically take more risk offer the opportunity for higher rewards. Although the potential returns seem very attractive, higher risk investments aren't right for most investors. This is because they also carry a higher risk of your value dropping, and this is what we call risk versus reward. Volatility, on the other hand, describes an investment's short-term fluctuations. These are market movements and they're easier to understand as they are more visible to us, and we can see how they directly impact the value of our investments. However, focusing on short-term volatility is a bad idea for longer-term investors, as prices change daily and gains or losses are not relevant until you sell your assets. This leads to one of the biggest risks we have as investors, and that is fear.
The main risk to people who invest are loss of growth. And I think when we're looking at that, if you leave your pension funds to run and run, you can see incremental changes to your pension funds, and that, as long as it's going in the right direction, you know, many people are happy with that. Obviously, markets, strategies, economic climate, general changes constantly. Things are always on the move, and it's the impact of this over the long term, as Julie mentioned earlier on, that really gives a huge difference to the returns that are available. Now, constant monitoring, as far as we're concerned, is much more favourable to people that have any type of investment, be it a pension fund or ISAs or anything at all. And what we've looked at is actually got some stats. I love stats. And the stats are around what the market average has done versus what a portfolio that we run for medium risk, moderate investors. And this is done over 20 years. And I think that it's actually quite shocking, the differences that are there. And the average pension investment, and we've taken this information from separate investment research, independent investment research, and the annual return over the last 20 years of the average of investments out there in a balanced risk category was 3.85%, just less than 4%. So the value of that fund, so if you'd invested £100,000 20 years ago, that would be worth 212,969. Sounds okay. You know, you might be quite happy with that. The difference when you have an ongoing monitored portfolio, we back tested our balanced portfolio in exactly the same risk category, and that would have returned 8% over that period of time, which gave a return end value of £468,906. Now, obviously that's a huge difference, but the question really that most people should be asking is, how would you feel knowing that you'd lost out on that potential growth? Because it's all well and good looking at things in the here and now, but when you look backwards, often people ask, well, what if? And I know with a lot of conversations I have with our clients, if somebody had lost over £250,000, they'd feel pretty aggrieved about it. Well, there's no way of knowing that's going to happen unless you have a crystal ball or you're looking backwards. So generally speaking, if somebody thinks that there's a potential loss there, they can maybe take unnecessary risks going forward to try and recoup those, and that's not always a good thing to do. So long-term steady growth is definitely the thing that's is the order of the day. To put that into context, what does that mean to somebody in retirement? In simple terms, that difference, that loss of growth, is the equivalent to £850 per month to be able to spend in retirement on whatever you like. So that is definitely worth having a look at and paying some attention to. If you wanted to find out a little bit more about what we do and how we run investments, have a look at our website. The link will be put up, and it's on our managed portfolio service section of our website. That information is there. Another risk is loss of capital, and recently spoke to a client who had saved £110,000 into his pension fund, obviously over a period of years, and he was contacted by a firm of investment consultants. The problem was that the investment consultant, he didn't know this, but wasn't regulated by the FCA. He didn't hold the relevant qualifications to give the advice that was required, and unfortunately for this client, the investment since collapsed. The investment was secured, stably on property, apparently. So it's bricks and mortar, backed by government, but it just seems not to be the case. Now, this is really, really important, and anybody who takes such a step should always make sure that the person that they're engaging with is regulated by the Financial Conduct Authority. So have a look at the FCA register, Google that, and you'll get to the FCA website and do a search for the firm. You can do a search on us if you want to, Libertas Wealth Management, and obviously myself and Julie are both on there, regulated by them. In addition to that, when we look at various things for clients, we always look at how investors are protected. Very, very important. There's a scheme out there called the FSCS, Financial Services Compensation Scheme, and that's the thing that you've probably heard of, that banks are for £85,000 for each investor, and it also covers investments as well, as far as things, companies going out of business or whatever it might be. There are protections available for investors as well.
That's a really good point, Phil. So, why do people invest? Well, actually, isn't it more risky not to? If we take your example before, and we take an investor, that person put that money under the bed, they would actually be losing money in real terms with the effect of inflation. So if you put £50,000 under the bed, in 20 years' time, it's going to be worth considerably less. Savings, there are really good savings accounts out there, and there is definitely a place for them for shorter term needs, but interest rates are extremely low, and while your capital should be safe as long as it's under the Financial Services Compensation Scheme limit, it will not beat the effects of inflation. Even longer term notice accounts, you're not getting anything more than about 1.8%. So that's why people invest. If we take your example, Phil, before, as a typical investor is likely to achieve returns in excess of inflation, net of all taxes and charges, and that's why people look to invest for the longer term. So if we look at a typical investment for an average risk client, we will diversify the investment, splitting your investments into different assets, and that's where we minimise risk as much as possible. This is called asset allocation, and we did mention this at our last webinar, and it's the proportion of your investment in each asset class. By mixing those different asset classes, we manage the amount of risk we take in your portfolio. It's extremely important, and it's one of the biggest things that we do for our clients. A typical asset allocation, it would be a mix of UK equities, developed international equities, government bonds, inflation-linked bonds, corporate bonds, emerging markets, properties and cash. And most of you will have some form of investment, typically through a private or a company pension.
So the biggest financial risks that often are being taken. I liked your example there, Julie, of putting the money under the bed. We don't hear that so much anymore because there seems to be, with inflation, larger amounts of money at stake. So you don't keep the money in the bread tin under the bed anymore. But even if you are thinking about doing that, chances are your home insurance won't cover it as well. So that's something that's been drummed into me by being involved in the insurance industry previously. But yeah, other financial risks, not planning. It's a major risk. You've probably heard the old adage, if you fail to plan, you're planning to fail. And basically by waiting until you have to act, that's often a big mistake that people make. Not considering early enough what the effect on your retirement will be. It's always been a thing in our industry, trying to persuade an 18-year-old to put money into a pension for when they're in the 60s. It's a very, very difficult thing to do, and I can understand exactly why that is. Priorities are completely different. There are much more fun things to spend money on than put money into a pension. But the sooner you put into a pension, the better it is, and you'll always be pleased you did. When it comes to even the risks that used to be there with pensions, you have the ability now to pass pension funds on to other people within your family. So it's not lost anymore. There's no, unless it's a final salary scheme that has fixed rules, there's no loss in doing that. So it's important really to make sure that you're considering what you're doing when as early as possible. Put into pensions, get used to it. And even I was talking to a client yesterday, talking about lifetime ISAs. Lifetime ISAs are a fantastic way to plan, because they give you some tax breaks, and you can use that as opposed to tying it up into your pension until you're age 60. Well, you can use that for a house purchase and still get tax relief on it. So there are some fantastic ways to do that. Most clients come to us saying that they really don't know where to start. So, if you don't know where to start, you tend to put things on the back burner. And that's what I would encourage everybody not to do. The first thing that you can do if you don't know where to start, pick up the phone to us. We can give you some pointers. It doesn't have to be any more than 10 or 15 minutes. But of course, we can go into as much detail as you want to do about what it is that you want to achieve. Some people feel that pension funds don't feel relevant to them. And I think this is partly to do with the regulatory statements that come out and the illustrations. They are very complex, and sometimes the figures that are on there don't really mean much to people. So that's a very, very common thing. Again, if you have any questions on those, we can explain them. And all that most people want to know is, will they have enough in later life? And that's a question that we can, I wouldn't say easily answer, but it's what we do every single day. So we have a process to go through that. A major danger with that type of thing is changing strategy and listening to people in the pub, for instance. Could be friends. So I've heard stories before about people. Guy in the pub has said, I took all of my pension money out of my fund and didn't pay any tax on it. Whilst that's possible, it's only if it's a very, very small pension fund. If you have a larger pension fund, there will be huge tax implications for doing that. And that's a huge risk. I have heard of people that did do that, and when pension freedoms came around, and there was the so-called Lamborghini fund, where everybody would be taking the money out of the pension fund and going and buying Lamborghinis. I don't think many people really did that, but if you were to do that, the amount of money that you would need to buy a Lamborghini, the tax costs of that would make your toes curl. So if you have any questions on that, we can gladly work out the implications. It's very, very important to know what you're getting into before you make any decisions on that.
I love the Lamborghini fund. One of the biggest risks is not knowing what you have. This is absolutely shocking. There is £20 billion worth of unclaimed pensions in the UK. And every time I say that to people are so shocked. But when you think about it, how many times during your career would you change jobs typically and change address? It's so easy to lose track of a pension. Also as well, if you haven't been there for very long and it's quite a small pension, it might be quite easy to forget, but these pensions do add up, and it's better in your pocket than in the pension provider's pocket. So I think it's really important for people to really consider what they've done, where they've worked. Could they have a pension pot that is maybe they've forgotten about? Get your paperwork out. We did speak about this, about being organised in our last webinar. I think it's really important. But don't be put off if you haven't got any paperwork and you think that you could have a pension. There are links that, there's a government website that you can use, and we will put the link with this webinar to help you. Because if you think about it, if there's that much of unclaimed pensions in this country, potentially could be somebody that's watching today that has got an unclaimed pension. So it really is important that you do look at that. And again, as Phil said before, if you're struggling and you can't find the link, pick up the phone and speak to us, and we'll help you with that. Going on from that is a lack of understanding. Here's another shocking figure, is that a recent survey carried out by one of the pension providers this year found that 66% of people do not understand what they have. They have a pension, they do not understand what they're in it. In fact, some people think that their money within their pension is in cash. They don't understand that it's invested. So it's really important that you do understand what you've got. It's a really good thing to build on, so we can help you with that, and we help you with that by you signing a letter of authority. And all that does is it gives you permission for us to obtain information on your behalf, where we can explain what your plan is, no obligation, and all we do is we write off to your pension provider and we ask for full information, and then we can explain it to you. Again, we're going to put a link with this webinar for you to be able to do that, which you just sign and you can send back to us. One of the biggest things I think you will agree, Phil, is never reviewing your financial product, typically a pension. I'm going to use the analogy of you buying a car. Would you buy a car and never get it MOT'd? You just wouldn't do it. It would be the most risky thing that you would do. By having an investment that's never reviewed, you are taking a substantial risk. It's likely that your circumstances will change, say, over a period of, say, 20 years, and so may your needs, and so may your risk. So your investment that was suitable 20 years ago, the likelihood of it still being suitable now is unlikely. So, review all the time. We typically review our clients' investments on an annual basis, and we can review them, more frequently if there is a need for doing that. Your investment may be unsuitable and also as well, if it's an old style product, like an old style pension product, it could be really expensive, and you could get something that's much more competitively priced now, and something that's more up to date and more suitable for your needs. So I think it's very important for you to do your homework. Not doing your homework can have a catastrophic result, as Phil mentioned before, with regards to the being regulated. If it sounds too good to be true, it is. So make sure you do your homework and make sure that any financial institution you use is authorised and regulated by the FCA, and you are covered under the Financial Services Compensation Scheme. You mentioned before, Phil, that there is a link. You can go onto our website. Our website address is www.libertaswm.co.uk. There is lots of useful information on our website. There is lots of useful links and there is lots of useful resources. Alternatively, pick up the phone 01925 320 655, speak to any of our team. One of our advisors will call you back as soon as possible. Thank you for listening for this webinar today.
Thanks, everyone.
See you soon. Thanks, bye.